Thank you very much. It's great to see so many people here interested to learn more about behavioural economics, which I think is the most interesting part of economics. So what we're going to run through today is a little bit about the theory behind behavioural economics and why it makes a lot of sense. There has been a couple of Nobel Prize winners in this field, but it hasn't been without contention. Basically, the traditional economists that use mathematical models have found that the behavioural economists are really second-class citizens, and they look sort of down on them. And there has been quite a bit of animosity and controversy around the whole field of behavioural economics. And one of the people that I'm going to talk to you about today, one of the founding fathers of behavioural economics, has had such a stoush with another economist that they both worked at the University of Chicago, and one a behavioural economist, one a traditional economist, it got so acrimonious to the point that if they would pass each other at the university, they would avert gaze and they wouldn't even acknowledge each other. So, I think it's super interesting that, again, this could potentially a behavioural bias that once you're wedded to an idea, it's really hard to let it go. And so perhaps the traditional economist didn't like the thought that everything, his life work, based on the mathematical formula of, utility, and which we will talk about shortly, was perhaps not the be-all and end-all, and so couldn't accept that, and so just closed his mind to it. So we're going to talk about framing and prospect theory, we're going to talk about mental accounting, and then we're going to talk a little bit about the paradox of choice, and then we're going to talk about some key behavioural biases. Now, we've only got time to talk through a few of those. There's well over 100 behavioural biases, but I've picked out a few that I think really resonate from an investor's perspective. So let's get right into it. The economic theory. This is the standard economic theory that's been around for centuries, and that is that as humans, we will make rational decisions that will maximise our utility. So what does that mean? We're going to make decisions that are going to maximise our wealth if we're investors or maximise our happiness. But what the behavioural economists found is this was too simplistic. There are many different nuances, and actually, in reality, we behave not rationally, but often in predictably irrational ways. And I've got pictures up of 3 founding fathers of the behavioural economics field. First one is Danny Kahneman, and then on the bottom right here is Amos Tversky, and they've done a lot of work on prospect theory, and it's not a new theory at all. In fact, they discovered this in 1979, and they ran a whole bunch of experiments with their students, and what they found is the way something was framed had an absolute impact on the decision that you would make, and this goes against all economic theory. And we'll talk about this in a little bit more detail. And at the bottom left here, you've got Richard Thaler, and he has worked with both Tversky and Kahneman quite closely. Unfortunately, Tversky has since passed away. And basically, Richard Thaler won the Nobel Prize in 2017 for his work on behavioural economics, and in particular on mental accounting, which we are going to talk through in a bit of detail. Now, Richard Thaler, you may recognise him. He did have a cameo in the movie The Big Short, and he's got a number of books that are well worth reading. So if you do want to if you do find after this session that you want to learn more, I absolutely recommend looking him up and reading some of his books. They're super easy to read, and they're full of great wisdom. So, why do we behave in predictably irrational ways? Well, we're human, we're not robots, number one. We're not a mathematical formula that we can actually sort of fit neatly into the way that we think. And so we find complex decision-making hard. Studies have shown that we're actually processing 5 times more information on a daily basis than we were 25 years ago. That's a lot of information to get through. And so as a result, we have a whole heap of shortcuts that we undertake to help make decisions efficiently and effectively. And we do make thousands of decisions every day, and we're probably even not aware of some of the decisions we're making. What time to get up, what to have for breakfast, how we're going to get to where we're going to, which route are we going to take, what are we going to wear. There's thousands upon thousands of decisions. And so we have these simple rules of thumb to help us make decisions. And then we really actually find self-control difficult, and we're going to talk a bit about this in the behavioural biases section. And so our emotions can get in the way, and that can be quite detrimental when we're talking about our investments. And the research has shown, this is from Kahneman and Tversky, that we feel the pain of a loss twice as much as we feel the pleasure of a gain. So therefore, we are inclined to make poor decisions in the face of a loss. And how things are framed can really influence our decisions. So I thought I'd show you this. Oh, sorry, I'm not there yet. So the theory is decision making should not be affected by the way alternatives are presented, right? But this is the number one violated rule, because we are absolutely strongly influenced by how options are presented to us. I'm going to show you this. So here's an example from a study done with surgeons. And when they were talking to their patients and they said to them, look, there's a 90% chance of a positive outcome if you undertake this surgery. They found that most patients would take up the surgery. Now, clearly this is being couched in a gain situation, a positive situation. However, when the same surgeons would speak to other patients and say, look, there's a 10% chance of mortality, they would find less people would take up the surgery. So this is a framing issue. Now, clearly they're equivalent situations, 90% positive, 10% negative outcome. And so this kind of then feeds into investment decisions, because when we're faced with a positive outcome, we tend to be less risk-taking. We can actually become risk-adverse when there's a positive outcome. However, if we're faced with a loss, we tend to be risk-taking. We tend to really take on the additional risk to avoid that loss situation. And there's a whole bunch of experiments around that. Another example, would you like the 4% full-fat milk or the 96% fat-free? Again, equivalent situations, just framed differently. One sounds better than the other. Don't know about you, but that 4% fat-free sounds better to me. And then framing can also impact on us in terms of subconsciously. So there's another study that was done in 2007 in the UK, and what they did is they piped music through a local liquor store. And they had, one day they would have French music, and the second day they would have German music, and they would alternate. So the French music was a lot of accordions, and the German music was a traditional Oompa German band. And the findings were that actually when the French music was piped through, far more French wine was purchased, 5 times more French wine. Amazing, right? And what's even more amazing is then when they would actually survey the people that had bought the wine at the register, they had no idea that they had been listening to French music. They had no idea why they had made that decision. They had no idea they were being influenced. So I just think that that's, again, we think we are these autonomous beings making these rational decisions, but actually we are being influenced either consciously or subconsciously on a daily basis through these shortcuts that we make to try and effectively get through all the decisions that we have to sort of consider. So, the economic theory now, we're getting into Richard Thaler's research on mental accounting, is that people see money as fungible. That means a dollar is a dollar no matter how you've allocated it, no matter what particular purpose you have for that dollar. Now, this is really quite astounding, but actually people treat money differently depending on where the money comes from and what they plan to do with that money. And I want to spend a bit of time on this because I think this is a really, really interesting discovery of Richard Thaler's, and this is really effectively what he won his Nobel Prize for. So, what the economic theory is that they, the pure economists say we think about our own personal investments and money like a balance sheet, like a company would. We're looking at it holistically and we're making decisions holistically. But we're not, actually. So typically, most of us are looking at our money in basically buckets or mason jars or in separate accounts. And the reason that we do that is for simplicity, so we can actually help make decisions around our money and also to help us budget and to help us manage our impulses to buy things. And so this is quite interesting because Richard talks about this whole concept of relative value. We absolutely care about the value of the deal. And so he gives a great example of a friend of his who wanted to buy a quilt for her bed. Now, the normal price for the quilts were $200, $250 and $300. $200 for the single bed, $250 for the double bed, and $300 for the queen bed. And lo and behold, the quilts went on sale. But what they did is they made all the quilts $150. So which quilt did his friend buy, keeping in mind she had a double bed? She did, that's right. She bought the queen size because it was a better deal. It looked like a much better deal on a relative basis. Even though she only really needed the double, she was quite happy to have the quilt hang down over her bed because she felt great about that deal that she was able to achieve. Another example is then in terms of sunk costs and opportunity costs. And so there's a great story about a couple that go on their honeymoon. They stay at this fantastic casino. They have $5 worth of, they buy a whole bunch of $5 chips. They spend the evening gambling. They lose all the chips. That's okay. Like, it was all entertainment. They're not worried about it. They didn't spend too much. They go to bed. The husband realises, hey, I've still got a $5 chip in my pocket. Wife's asleep, goes, I'll just go down and bet that last final $5 chip. Goes to the casino, puts it on black. He wins. Now his $5 is worth $50, and he keeps putting it down, he keeps betting, and he keeps winning, and he keeps winning, and he keeps winning. He gets up to $1 million. Whoa! So, he's had such an incredible run. Anyway, what happens next? He loses it, loses the lot, keeps going, loses it, goes back to the room. His wife wakes up, says, oh, where have you been? He said, oh, I just went down to the casino I found a chip. She goes, oh, how much did you lose? What do you think his answer was? $5. And this is part of the research that Richard Thaler did, is saying, actually, we don't think about the opportunity cost and we treat money differently. And at every point in the way when he was winning, that was real money that he could walk away with. So, he could have walked away with his $50, his $100, his $200, right up to his $1 million. But every time he just discounted that and just kept on gambling. And then when he came to actually confess the outcome of his gambling, it was all about the initial outlay, the sunk cost, not the actual opportunity cost and the money that he could have left with. And the other thing that Richard's tried to work at is, why do people pay more for a purchase on a credit card than they do in cash? And the reason they do that is because of this transaction decoupling, because they're actually paying for the purchase in a future time and they're getting the purchase now. And so all the little small purchases add up. It's actually insignificant versus the actual size of the credit card bill that you're going to pay at the end. And so this is, again, a behavioural bias. And then in terms of these mental accounts, so we set up these mental accounts, and I know when I looked at this research and thought about it, I absolutely do it myself, so there's a very good chance that you will do it as well. I have my budget for my household expenses, I've got education expenses, I've got holiday special fund, and I've got money set aside for my children. Now, when my credit card comes due and I need to pay that, and maybe I don't quite have enough to pay it out in full, which is very bad, I should, I will not touch the money that's been set aside for my children. Now, this is crazy because my credit card expense, my interest rate on my credit card is far higher than the return I'm generating on my children's savings. But it's a way of self-control. So if I start dipping into that account, I don't know if I'll be able to control myself, so I just don't dip into it at all. So it's just something to be aware of, that these are some of the ways that we think about money and behave, and it could be to our detriment. And the final bit is, why do we spend a small inheritance but save a large one? If we don't budget for those expenses, then we just tend to spend willy-nilly. And so when my grandmother used to say to me, look after your pennies and your pounds will look after themselves. She was absolutely right, because if we actually if we're looking at those smaller expenses and we're not thinking about them, when we don't budget for them, then it's easy to sort of fritter the money away. And whereas the larger amounts that we do actually allocate to a budget and to a bucket, we're more likely to preserve. And then the final bit here is the Weber-Fechner law, and that's really basically, again, some more study by Richard in terms of, why will we go across town to save $10 on a $15 calculator, whereas we won't be as inclined to go across town to save $10 on a $150 jacket? And that's because, again, it feels like it's less significant from the jacket because it's a larger amount, even though it's still $10. At $10, the money is fungible, and a $10 saving should be a $10 saving no matter what account, no matter what the purchase. But it doesn't feel as significant as it does when you're talking about a $15 calculator and you're getting a $10 off that. That's a significant deal versus your $125 jacket. Cool. And so the next thing I want to talk about, this is going to finalise the behavioural economics sort of lesson, is the paradox of choice. So the line of thinking is that the more choice we're offered, the better, because we're able to find exactly what we're looking for. But here is the paradox. The reality is if we have too many choices, we find it really hard to make a decision. And in fact, we might not make a decision at all. So I just quickly had a look at how many superannuation strategies there were available and how many pension and annuity strategies are available in Australia. And there's quite a lot. I was surprised actually how many. There's over 3,000 superannuation strategies and over 2,000 pension and annuity strategies. And so this comes down to then, how do I then make a decision on where to invest, and who do I go to? How do I curate that list? What do I do? And I think that's probably why you like to utilise Morningstar, because Morningstar helps you with the research, does the curation of the list, so you can then sort of limit that thousands of strategies down to a few that you can then think about and look at. I'd like to draw your attention to a study on jams and chocolates. Now, this is a study done by Iyengar and Lepper in 2000, and basically they demonstrated this paradox of choice issue quite nicely. One Saturday, they had a jam store set up at a supermarket. There was 6 jams to choose from. The idea would be you would taste the jam, and if you really liked the jam, you would then go and purchase the jam. And so that all went really well, and people were tasting the jam, people were buying, but and there wasn't really a lot of super amount of foot traffic, but it was all pretty happy. The following Saturday, they did the same thing, but they had significantly more to choose from. I think it was 26 different jams to choose from. So there's quite an array. It was quite spectacular, very colourful, and they were inundated. People were going past and tasting jams like crazy. So foot traffic out of control. However, what do you think the results were? Yeah. Funnily enough, whilst there was a lot of tastings and foot traffic at the high choice offer, it actually generated significantly less sales. And in fact, the limited choice offer the week before, 10 times more sales. So again, showing that perhaps it was just too overwhelming. It was difficult to make a decision on which jam you wanted to buy in the face of so many choices. And so then they did a subsequent study with chocolates, very similar, limited choice, extensive choice, and they asked a follow-up question. And they said, how happy are you with your purchase? Again, really interesting findings. What they found is that people that had bought from the extensive choice table were actually less satisfied, probably because they were second-guessing themselves, because they had so much to choose from. Did they make the right decision? They didn't feel really particularly convinced that they'd made the right choice, and so therefore they didn't feel particularly happy, whereas those from the limited choice chocolate table were quite satisfied with their choice. And so I think that this goes to show that it is, that less choice is better, and you're going to feel happier if you're looking at a curated choice than you're looking at the whole market. And you just literally can't consider research properly the whole market. Okay, so now I'm going to get into the behavioural biases bits. And so this is something that we're all guilty of. Like, we're human. We have, we're rational, but we also have emotions, and, they go together. And sometimes we can be extremely rational, almost like that cyborg that the traditional economists want us to be. And, we're looking at utility and we're making decisions rationally. And other times we're going to be a little bit emotional, and we're going to give into those human emotions. And so really behavioural biases are not bad things at all. They serve us extremely well in everyday life because, as I said before, 25 years ago, we had a whole lot less decisions to make. We're making, we've got 5 times more information coming at us now. And so how do we make those decisions quickly and effectively? We're following our experience. And so in everyday life, serve us well. Saucepan is hot. You touch the saucepan, you're going to burn yourself. You drive too close behind a car, you're at risk of running into the back of that car. If it's cold, please put your jumper on. I try and tell my 10-year-old that all the time, and she doesn't listen. But, these are simple, everyday shortcuts that we know to undertake to make our lives easier. However, when we're investing, they can actually be to our detriment and can lead to what's called seemingly irrational behaviour. And so I'm going to run through a few of these now. Past performance can mislead us. How many times have you seen past performance is not an indication of future performance? We get that warning all the time. Yet, as humans, we do put weight on it. And so we've got to be really careful with that. And so this is known as recency bias. We put weight on the most recent information that's given to us. And we basically extrapolate that out and expect that to be the same for the future. And so that is why people keep on buying when markets are rising, when really you're buying high. Is that sensible? Probably not. But if you think that you've got this recency bias and you think that it's going to keep on rising, it seems reasonable. And conversely, when markets are falling, it's an opportunity to buy, but we tend to sell because, again, we keep thinking, we extrapolate that out, that it's going to continue to fall. So it doesn't serve us well. So in the light of in the light of recency bias, it's just good to stop and go, am I being rational and reasonable here? Is this really the right time to be buying? And I'm going to now leak into the next bias, which is following the crowd, which is very similar, or is quite nicely interlinked to the recency bias. And I'm going to tell you a story about the dot-com boom. So in 1996, there was an Australian tech stock called Sausage that launched its IPO. And it was just as the dot-com boom was taking off. Obviously, in the US, the dot-com boom was pretty significant as well. And I was working in investment banking at the time. And I remember that there was a utility company that wanted to do an IPO. They wanted to list on the stock exchange. I remember listening to their advisor at the bank, at the investment bank, saying to them, you know what, you should just put a .com on the end of your name and you will be so successful, because that was what was happening. Everyone was following the crowd. Everyone was really excited. This time it was different. Technology stocks were the future, and anything with the .com seemed to be doing extremely well. People were ignoring the fundamentals. They weren't looking at the profits. They weren't looking at the cash flows. They were just going, .com, it's the future. Now, Sausage shares, just before the .com bubble burst, hit $40 a share. And then, unfortunately, eventually, I know Alan Greenspan was talking about irrational exuberance. He couldn't understand it. I think Warren Buffett stayed out of the tech boom. He couldn't understand it. And it did take a while, and this is really human behaviour that really fed this. But eventually the fundamentals did matter, and of course the bubble did burst. Now, a year after the bubble burst, Sausage shares were worth $1.80. Now, Sausage wasn't a bad company. It was just that the crowd, our own human emotions, we didn't want to miss out. Everyone was doing so well, and everything was doubling and doubling and doubling. It just seemed like a good thing to do. It felt great to be part of it until it didn't anymore. And so I think that the risk there is, are you following the crowd, or are you doing your own research? Does it make sense? Do the fundamentals stack up? Is this really a good investment? Does it stand on its own merits? Don't get caught up in the euphoria. Okay, I've got another picture here. This is actually a human blinker, which I found pretty interesting. We work in open plan offices. Open plan offices are pretty common these days. And so I think this is Panasonic. Yep, Panasonic have put this prototype out to help people not get distracted in open plan offices and wear blinkers. And I thought that was a nice analogy for confirmation bias. And confirmation bias is when we seek out information that backs up our point of view. And we might not realise that we're doing it. And it's really dangerous now with social media, because the algorithms actually know what we like and interact with and keep feeding us that information. So it can form a bit of an echo chamber, and you can get really biased, you can get one-eyed. And so it's something to be aware of. And I think the best example I could think of from a confirmation bias perspective is I was on the plane watching a documentary about Theranos. Now, I don't know if any of you have heard about Theranos. Elizabeth Holmes, it was a biotech company in Silicon Valley, had incredible backers. George Shultz was the chairperson of the board. She also had Henry Kissinger. She was interviewed by Bill Clinton. She was on the Forbes front cover. Rupert Murdoch invested $100 million into her company. She actually raised $900 million. The company was worth $7 billion. You know, she was considered like the darling of Silicon Valley. And she was hailed as the next Steve Jobs. You know, incredible hype around Theranos. And the whole point of Theranos was, instead of having to take a vial of blood to actually, you know, do analysis, you could just take a pinprick. And then it would be cheaper as well because you're not taking as much blood out, and you could actually get regular blood checks and keep in front of any potential diseases that you might have. So a fantastic idea, fantastic theory. Unfortunately, it didn't work. And so long story short is that Schultz was such a fan of her story. He had invited his grandson to come and listen to her sort of talk to him at his home, and his grandson was studying at Stanford University. She was a Stanford University dropout. She dropped out to basically start this company. And he was, you know, she's an incredible storyteller. She had such an incredible vision. She had so much support. She had, you know, it was amazing. And so the grandson, Tyler, said, "Oh my gosh, this is amazing. Can I please intern with your company? I really want to be part of this. This is awesome." And so she said yes, and he went and did that. And then he finished his degree, and then he went back and got a full-time job there. And then not long after that, he started to realise that perhaps all was not what it seemed. And so basically the promise of what they were able to deliver and the delivery were worlds apart. And they had started actually performing these diagnostics on real people. And so he felt very ethically unhappy about this because people would be getting information that was perhaps not accurate, and they would not be aware they had, say, hepatitis when they did. And so, you know, there was a major problem, but also very scared because of the backers, and they were very litigious. So anyway, he ended up bringing it to her attention. She didn't want to know about it, so he ended up resigning. And then he went to his grandfather, George. You know, this is his grandson. They're pretty close. And he said, "Look, it's all, you know, there's a whole lot of problems. Here's some facts. Here's some figures. Here's the evidence. I've been working in there. I've been working in the labs. It doesn't work. It's a problem." And his grandfather wouldn't believe him. His own grandson, he believed Elizabeth Holmes so much. You know, he'd bought in so much. You know, and he said, "Everybody else is on board with this. You know, I think you're just mistaken. You know, I cannot believe it." And it did cause a rift. They didn't speak for a while. Anyway, he ended up turning out to be a whistleblower. The whole company shut down in 2018. She's on criminal charges. He's mended a relationship with his grandfather. But I think a great example of confirmation bias is like, no, I cannot listen to you, grandson, and I cannot listen to these facts and figures. Everyone else is telling me it's great. Elizabeth's telling me it's great. Everyone else on the board thinks it's great. Mind you, the board didn't have any medical experience, had a lot of government experience, but no medical experience. And so he wouldn't listen. And so, you know, it all ended up pretty poorly. I am running out of time. But the only other one I was going to talk about is action bias, and that's the bias that we think to do something is better than doing nothing at all, but actually sometimes it's better to do nothing at all. And this is in relation to have your plan and stick to it. Don't meddle. Don't look at things, you know, on a daily basis and start worrying. You know, be clear about what your objective is, and then, you know, stay the course. And so this is relating to soccer goalies. They've done a whole study on this, and what they found is the best place for a soccer goalie to be is right in the middle of the goal at a penalty shootout. But soccer goalies will either, you know, jump to the left or jump to the right. And when they asked the goalies why they did that, they said because it was better to be seen to be doing something than to be doing nothing. Yeah, and what they found is that actually they'd be 33% better off standing in the middle, and it was twice as effective as jumping to the left or jumping to the right. So, you know, again, don't get sucked into that and thinking, okay, something's changed, I need to now do something, because that actually is one way to erode your wealth. You know, you need to be really clear about what your long-term strategy is and stick to it. Not that I'm offering advice, but, you know, this action bias can be a real problem. And Carl Richards shows it well. Basically, most investors don't even get what the investment return is, what the market return is, because they do behave poorly, because they, with well-intentioned, they're reacting to the information that they're being given, and therefore they're trading and potentially at the wrong possible time and eroding value. So the final slide is, you have a lot of power as investors. I think the most important thing that you have is the way that you can manage your own behaviour. You're going to hear a lot of information today, and it's really fantastic to get educated and to understand where the opportunities lie. What are you going to do with that information, and how are you going to make decisions? And I think being aware of some of the behavioural biases and the research in behavioural economics can really help you. And so, whilst you can't control what's happening in markets, you can't control what's happening in politics, you can absolutely control your behaviour. How much you save, how much you spend, what your plan is, what your asset allocation is, what your risk profile is, how much risk are you comfortable taking, where you invest, what your investment time horizon looks like, and how much you trade, because each time you trade it costs, and that could also be potentially eroding your returns. So the only final thing I want to say is I think that on your seats was information about a Morningstar ETF. So I just wanted to let you know that's a new strategy that Morningstar is releasing to market. I think it's November the 1st that it's going to be available. So if you are looking to outsource some investment decisions to the experts and control your behaviour that way and get diversification, then that's something to have a look at. Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.